Okay, good morning or good afternoon rather to our viewing audience, and welcome to this webinar hosted by Bourse Securities Limited, titled Where Do Markets Go Next? And today we're going to be focusing a lot on the performance of financial markets over the first half of 2022 and what investors might expect going forward in the coming months and perhaps even beyond the rest of 2022 into 2023. Certainly a lot of very dynamic situations affecting and influencing market sentiment and direction over the past couple of months. And it has certainly worn on investor portfolios to the downside in the first 6 months of the year. So in today's webinar session, firstly, let's look at webinar housekeeping. You can submit your questions at any point in time using the Q&A box, which would be to the lower part of your screen in that in the Zoom menu. The presentation time would be approximately 20 to 25 minutes, and we would be addressing as many questions as we can at the end of the session of the presentation, that is. So again, please feel free to submit your questions throughout the presentation, and our moderators would field as many of those to myself, the presenter, Sarod Ramkalawan, at the end of this presentation. So in today's webinar, we're going to be looking at three very basic sections. One, what would have happened over the first half of 2022? Certainly, it has been a challenging 6 months, and the question, of course, on investors' minds would be, is there much more of this ahead? The second is a local economic snapshot, very briefly. And the synopsis overall is that it is better for now. And of course, the most important question on investors' minds is what is next? And that is where we will be considering the investment outlook, as well as how different risk profile investors can position their portfolios to best weather whatever challenges and opportunities may be presented in the coming months. So firstly, let's take a very quick review of what would have occurred over the past couple months. And that would be, firstly, we'll take a look at the local markets and is it a healthy correction? When we take a look at what would have happened to our local stock markets or indices on the Trinidad and Tobago Stock Exchange, it doesn't make for very pleasant reading, certainly. The Trinidad and Tobago Composite Index, which comprises both our locally listed companies as well as cross-listed companies, would have declined just around 7.7% as at the 30th of June in that blue line. And that really would have been perpetuated by, in a major fashion, somewhat of a capitulation in the cross-listed index names, which would have been down just around 21.5%. Our all Trinidad and Tobago index, or locally listed companies, would have held their own fairly well, down just around 2.4% overall. But still, it doesn't make for quite pleasant reading. When we take a look at some of the major performers or underperformers, for that first 6-month period of 2022. On the positive side, you can see Agostini's Limited, or AGL, climbed 42.3%. Agostini has been continuing to grow through acquisition in particularly appealing industries such as the pharmaceuticals industry. And Angostura Holdings Limited also, somewhat of a defensive stock with whose products are consumed in good times and in not so good times, up 27.2%. Scotiabank, one of the most generous dividend yielding stocks on the Trinidad and Tobago Stock Exchange, up 12.2%. Plipdeco for PLD up 7.9%. And Trinidad Cement Limited, notwithstanding some headwinds to consumer demand, up 3.4%. On the other side of things, in terms of the underperformers on the Trinidad and Tobago Stock Exchange, well, it doesn't make for very good reading. NCB Financial Group down around 31%, and that would have been one of the major factors leading to that significant underperformance of the cross-listed index, being one of the largest cap securities on the Trinidad and Tobago Stock Exchange, as well as the cross-listed index. First Citizens Group Financial Holdings, or FCGFH, who is currently in the middle of its additional public offering, down about 20% year to date, well, as at the half-year point. First Caribbean International, again, a major regional financial services group, down 18%, with who are traditionally high dividend yielder, down 18% as well. And Unilever Caribbean Limited, after the sale of one of the major parts of their business, down just about 14.3%. So certainly some of the larger cap stocks, particularly in the banking sector, which is traditionally the largest sector on the Trinidad and Tobago Stock Exchange, having some fairly significant declines, and that would have led to the decline in the overall market. When we take a look at the sector performance, we can see that the conglomerate sector, with names such as Grace Kennedy, Anson McCall, and Massey Holdings, would have been down 10.8% for the half year of 2022, compared to 20.9% up in the half year period of 2021. And the banking sector, again, traditionally the largest sector on the TTSE, down about 12% compared to a modest gain in the first half of 2021 of 1.7%. So when we take a look at across, well, of course, Agostini would be in that trading segment of 35%. So when we take a look at the fixed income side of things, we can see that in terms of the government of the Republic of Trinidad and Tobago yield curve, there has not really been too many changes across that longer end of the curve, and we're talking about from 5 years to 30 years, not much changes in terms of yields over the past 6 months, indeed over the past 18 months. However, at the 2-year period, or the shorter end of the curve, we have seen a material increase in the yields that are being offered by government securities. And that yield would have increased from 0.9% in December of 2021 to 1.75% as at the mid-year point, June 2022. So certainly improvements in short-term yields, but really not much change going across the longer tenors of the government of Trinidad and Tobago yield curve. And this has really been perpetuated by an acceleration in local inflation rates. And this is not just constrained to Trinidad and Tobago. This has indeed been a global phenomenon. And we can see from the beginning of the end of 2021, or sorry, the end of 2020, we would have seen a steady uptick in inflation rates, with headline inflation in its most recent print, that's April 2022, for Trinidad and Tobago at 5.1% in that red line, and core inflation has ticked up to 4.1%. And this has really been perpetuated by supply chain issues, by increasing cost of base commodities such as oil, gas, agricultural commodities, among others. And that will continue to contribute to higher cost of living pressures for the general citizenry, and could impact corporate performance in the coming months ahead. When we take a look internationally, well, it has been about unbridled uncertainty over the past few months, not least the standoff between Russia and Ukraine, and the knock-on effect, the very significant knock-on effect that has been having across global financial markets as well as commodity markets, and leading to strained geopolitical relations or international relations. And that has filtered into negative investor sentiment, and it has led to a broad decline across most major regions in terms of equity markets. We can see the US markets, as measured by an investable ETF, the SPY, is down 20.6%, or was down as at the half-year point, June 30th. The Asian markets, as measured by the Asia ex-Japan ETF, was down 16.3% in that first half of 2022. Europe, as measured by a European ETF, core ETF, is down 22.7%. And Latin America, despite being up in the initial stages of 2022, closed the half year at negative 3.9% return overall, signaling again very broad-based declines despite whatever region that you may have been focused on with respect to your portfolio. And much of this, in addition to the geopolitical risks that have reared its head, has been also attributable to climbing inflation. And we can see, looking at one of the largest economies in the world, US inflation, as at earlier this week, in terms of its June inflation number, its core consumer price index, year-on-year prices would have increased just about 9.1%. Core inflation would have been up just around 4.7%. But what this is doing at a global level is increasing the cost of goods and services. And we can see in other major countries or regions that inflation as of June, India, for example, recorded 7% inflation, China less, 2.5%, the Eurozone at 8.6%, and Brazil recorded almost 12% year-on-year increases in prices. And this is going to continue to weigh on consumer demand as as the dollar or the value of goods and services that you can purchase for every dollar spent becomes less and less. And this increase in inflation has prompted the US Federal Reserve to increase its interest rates after cutting to near zero interest rates in early 2020 because of the COVID pandemic. The very sharp increase in inflation over the past few months has led to a very significant change in policy direction, where benchmark interest rates, the US Fed fund rate, as it will, has now been increased to 1.75%. And there has been a fairly straightforward communication by the Federal Reserve that they are seeking to get this rate up to as high as 3.5% by late 2022 to early 2023 to try to arrest runaway inflation at the global level and certainly within the US economy. And this could have the impact of not just cooling consumer demand to more moderate levels, but certainly it could derail the economy and economic growth, not just of the US, but at a global level. With this increase in US policy rates, we have seen US Treasury yields increase. This is the rate of return that is offered to investors in US government bonds. And as at the end of December 2021, we would have seen two-year rates, for example, at 0.73% for a US Treasury, a two-year US Treasury. That, as at today's levels, has actually increased to 3.23%, reflecting significant concerns of inflationary pressures to the extent that the yield curve in the US has actually become inverted during the course of today and a couple other occasions throughout 2022, where 10-year yields are actually, or 10-year government bond yields in the US are actually returning less to investors relative to shorter term yields. And you can see that in the 14th of July yield curve, where a two-year Treasury is offering close to 3.25%, whereas a 10-year government bond, US Treasury government bond, is offering just about 3%. So certainly we're not in normal times, and investors should really be approaching how they position their portfolios with a certain degree of caution. That broad repricing of the US Treasury curve has also led to a broad repricing of credit markets, and that has also led to increased yields and lower prices for some names that might be more familiar to our local investment community or investor community. So let's take a look at the Tringen or TGU 5.25% bond that is due to mature in 2027, for example. 12 months ago, that bond would have been yielding just around 4.3% per annum. Currently, it's yielding closer to 5.6% per annum. So there has been an upward shift in that yield. The Trinidad and Tobago government US dollar bond, which is due to mature in 2026 and offers a 4.5% coupon. 12 months ago, it was yielding as low as 2.8%. And currently, investors, if they so choose to participate, could earn a yield on an annual basis of around 5.1% per annum. So certainly a very sharp upward shift at a more in interest rates and bond yields, and it makes for much more attractive reading for fixed income investors who are seeking to add to their particular portfolios in the current environment. But let's take that with a pinch of salt, because policy rates in the US could increase even further from their current levels, and that could also drive yields further upward across not just US Treasury bonds, but also bonds that are closer to home and closer to the investment heart of our portfolios, such as the NGCs, the Heritage Petroleums, Trinidad and Tobago government, etc. And this is a phenomenon not just occurring across Trinidad and Tobago centric bonds or regional bonds, but overall, when we look at the investment grade and high yield emerging market bond indices, we can see that year to date, there has been a fairly significant deterioration in performance. The total return for the investment grade bond market, for example, is down about 15% at the halfway mark of 2022. And for riskier high yield or speculative grade bonds, the bond segment, that is the returns are down just about 17.6%. So that's a quick review of how markets would have fared at the halfway point. Let's take a look at where our local economy is. And it's safe to say, under the current circumstances, we are in a somewhat better position than we were just, even at the start of 2021. So what is driving this supposedly more positive outlook? Well, with higher energy prices, particularly for oil, natural gas, and the commodity derivatives that Trinidad and Tobago produces, such as methanol, ammonia, etc., that is going to certainly lead to an uptick in growth or projected growth for the Trinidad and Tobago economy. The IMF has predicted, or projected rather, that TNT real GDP growth for 2022 is going to get to somewhere in the region of 5.5%. Of course, these projections may be updated and upgraded later during the year, given the recent explosion in inflation rates. But the most recent forecast was for 5.5% growth. The Ministry of Finance at the mid-year review would have forecast that revenues for fiscal 2022 would come in about 10.4% above its initial projection. Inflation rates as at April 2022, while not as high as the US rates, are still fairly high at 5.1% as mentioned. But again, this is certainly lagging information relative to the US, where we have June data. Our inflation rates are April data. So there could in fact be an uptick in that inflation rate. Interest rates, the repo rate, which is the benchmark rate for the Trinidad and Tobago economy and is set by the central bank, was maintained at 3.5%. So some indication that the central bank wants to maintain a stable or relatively stable rate policy for as long as it can practically do so. The Ministry of Finance also forecast that its debt to GDP level for fiscal 2022 would close at somewhere in the vicinity of 72%. So certainly not as high as was initially projected at the original full year budget, but at the mid-year review, there was some moderation of debt to GDP levels from that 83 to 85% level down to 72%. And in terms of foreign exchange, well, we would anticipate that there has been increased energy-derived foreign exchange flows coming into the economy, which would ease some of that foreign exchange shortfalls that is being experienced by the manufacturing sector. However, from an investor standpoint, investors still have fairly limited access to foreign exchange for investment purposes. So while it might be getting better at the manufacturing level and other levels, investors still may be a little bit disappointed in terms of the amount of foreign exchange that they may be able to access to pick up some financial instruments in international markets. Some other considerations that our investors usually ask about with respect to our outlook. The local interest rate environment, we expect it to remain fairly stable. The central bank, in our view, has a priority of maintaining fairly accommodative growth for the Trinidad and Tobago economy at this point in time, given that our inflation in Trinidad and Tobago for goods and services is primarily imported. And under the current circumstances, maintaining an interest rate differential between the US Federal Reserve, who is rapidly increasing interest rates, and the Trinidad and Tobago policy rate, that repo rate of 3.5%, may be a lower priority. The effect of rapidly increasing domestic interest rates could lead to a significant deterioration in credit demand from consumers, and that in itself could stall non-energy sector growth across the economy. One of the other major questions that investors typically ask is, well, what's going to happen to our TT dollar currency? Will there be a devaluation? And under the current circumstances, we at Bourse view it as being less likely. One, our international reserves have been bolstered by special drawing rights in recent times, where we would have received a windfall of approximately $640 million added to our international reserve coffers. We have about 6.77 billion in those international reserves, which equates to about 8.3 months of import cover. And as of December 2021, the Heritage and Stabilization Fund remained relatively healthy with a $5.6 billion balance. That may have changed over the past few months, given what has taken place across investment markets, but nonetheless, we expect the country to be in a pretty good position as it stands with respect to international reserves and the Heritage and Stabilization Fund. And finally, we've been hearing for the past couple of years about the likelihood of falling into non-investment grade status with credit rating actions. We view that under the current circumstances as being less likely. We are currently still rated investment grade, and that is Trinidad and Tobago is currently still rated investment grade by Standard & Poor's. And with higher energy prices, notwithstanding fairly muted production or stable production, that should buy some time in terms of maintaining our investment grade status for at least the next few months. And here we can see when we take a look at crude oil production year to date, it has averaged around 60,000 barrels per day. But when we look at the average prices based on WTI, we can see that there has been a very substantial increase in average prices, with the average price during the course of 2022 around $102 per barrel compared to 2021 of $68 or thereabouts per barrel. The same has been observed in terms of production and prices for natural gas, where natural gas production for year-to-date 2022 would have averaged about 2.7 billion standard cubic feet per day, but the prices of natural gas relative to Henry Hub prices, that is, would have increased to $5.71 per MMBTU versus $3.90 over the entire course of 2021. So from a production standpoint, not too much to shout about as yet, but from a pricing standpoint, it is certainly a very good time for the Trinidad and Tobago economy. So what is next for investors in terms of the outlook? Well, at the local level, there are several drivers which will impact sentiment. The first being that GDP is expected to recover, as we would have mentioned, and that should, all of the factors held constant, lead, or that is a higher likelihood in the current environment, and that should lead to slightly improved investor sentiment. And that will be driven by higher energy revenues, which are much more likely, as the previous graphs would have shown, and that should weigh positively on investor sentiment. The energy production story, however, is a big question mark. There have been several false dawns in the energy production forecast since 2018 or thereabouts, and a couple of failures to launch in terms of that material recovery in production. In fact, production may have gone the other way and declined but certainly there are forecasts for a material improvement in production of natural gas and crude oil by 2027 or 2028. And we will wait patiently for that to occur. Meanwhile, we will enjoy what Trinidad and Tobago economy should be able to enjoy some benefits from higher energy revenues. In terms of investor sentiment, lower or stable interest rates, which we view as being a more likely outcome in the near term, it could have a mixed impact on investor sentiment, given that continued inflationary pressure could lead to an increase in interest rates over time, and investors may be a little bit on the fence as to what currently stable rates mean for fixed income investments in Trinidad and Tobago dollars. As mentioned, those inflationary pressures are more than likely to be higher in the near term, and that could weigh a bit on investor sentiment, given that it will affect the pockets of consumers and their disposable income, and that could lead to some weakness in corporate performance or corporate financial performance. One of the bright spots for local investors, however, has been an increasing trend of geographical diversification by many companies, certainly many listed companies, who are seeking to grow through acquisition in markets outside of Trinidad and Tobago, though they would be in very similar businesses, and that would impact sentiment or generally impact sentiment more positively, meaning that there's a greater degree of risk mitigation and risk diversification within a single investment, because companies are now seeking to diversify their own operations by geography. When we take a look at the local equity outlook for, well, through the eyes of Bourse, that is, there are a couple notable companies that we have an overweight rating on that are publicly listed. One of them being TTNGL, and that would primarily be, and that would have been upgraded to overweight because of the more robust energy price environment, as well as its international acquisition efforts. It has been expanding its footprint in the US market, for example, with some acquisition of terminaling facilities, and National Enterprises Limited as well, with more robust energy commodity markets. In terms of pricing, we expect that NEL will continue to do better in subsequent periods and could even resume a more robust dividend to investors. Swiss Caribbean International Bank is also one, well, rounds out our overweight ratings at this point in time, given their fairly attractive price to earnings ratio of about 7.5 times, a fairly attractive dividend yield of about 5.4%, and a pretty good story in terms of buying an asset in TT dollars that pays a dividend in US dollars to investors. So on that basis, FCI would be in our overweight category. Otherwise, there have been no major changes to our market weight or neutral category. Republic and Samacal, some of the larger market cap stocks remain in this market weight category. One stock that would have moved from underweight to our market weight category recently would have been First Citizens Group Financial Holdings, and this would primarily have been on account of its correction in price down to that $50 level, which makes it a little bit more compelling in terms of value relative to the rest of the banking sector. Slightly expensive still compared to some of the names in the banking sector, but offering a reasonably good dividend yield of 3.1%. Internationally, we expect many of the drivers that would have impacted markets year to date to continue for the foreseeable future. We still expect significant supply chain constraints, not just in terms of logistics, but in terms of sourcing and supply of raw materials to make manufactured goods. That likelihood is higher, and that will continue to weigh on investor confidence. Geopolitical tensions, and we're speaking specifically about the standoff in Russia and Ukraine, is expected to continue. It has devolved into a seemingly obvious battle of the egos between the West and Russia, with Ukraine as an unfortunate bystander. in a very precarious position, and that with its associated disruptions to financial markets, to agricultural commodities markets, to energy commodities markets, is going to continue to weigh on investor sentiment going forward. Persistent inflation is also expected to continue weighing on investor confidence at the global level, and higher anticipated interest rates, certainly for bond investors, being a near certainty, is going to weigh on investor confidence and increase collectively market volatility across all asset classes, whether you're invested in stocks, bonds, or any related or derivative items. And with increased interest rates, the prospect of slower economic growth and market volatility, we expect that there's going to be increased credit rating actions by some of the major rating agencies, and that could also weigh on investor sentiment. So how would an investor position their portfolios going forward? Well, there are a couple of overarching themes. The first is, in the current environment, investors should really be favoring diversification, not having all of your eggs in one basket, whether that means one particular stock or a handful of particular stocks or one particular asset class. You really should be favoring diversification. If you have the luxury of diversifying by currency as well, with access to currency, free access to currency, you should definitely be diversifying by currency also. Regardless of your risk tolerance, you should be, or we think that you should be opting for a much more safe approach, or opting for safety in the current circumstances, simply because there are many highly uncertain variables which could have fairly significant negative impacts or downside risk to investment positions. And of course, given that very large number of variables with high uncertainty levels, you would need to monitor your positions closely and make changes fairly frequently, one, or two, be invested in securities that have that professional management built in that will make those adjustments almost automatically. And examples of those could be exchange traded funds or professionally managed mutual funds. But generally, those are the overarching themes. At the investor specific level, whether you're an individual or whether you're an institution, you really should be considering your investment time horizon in determining what are the types of investments that you would be willing to hold in your current portfolio. And of course, what your liquidity needs are in the current environment, given that there's a high degree of volatility and uncertainty. If you do have higher liquidity needs, you would not necessarily, or you should not necessarily be holding too many securities such as stocks or even high yield bonds whose prices could fluctuate wildly over the near term. So as we get to the end of our presentation for today, before we move into our question and answer session, we're just going to take a look at some of the investor risk profiles and where those different types of risk profiles and portfolios should really be positioning in terms of international stocks, local stocks, international bonds, local bonds, and other types of investments. And we broadly categorized these risk profiles into the ultra low risk, the conservative risk, the moderate risk, and the aggressive risk investors. And as you can see, as we move from ultra low to aggressive, that component outside of cash or near cash and in bonds and stocks increases sequentially as your risk tolerance increases. So firstly, for the ultra low risk investor, well, securities or instruments such as deposit type instruments or repurchase agreements or fixed NAV income funds might be the best bet for you in the current environment, given the amount of uncertainty that is swirling around financial markets. If you are dabbling in specific securities, you could look at, for example, in the international bond segment. Again, you may want to consider much higher credit quality or higher credit rated securities, whether or not you're looking at government or corporate bonds. So for example, earning 3 to 3.25% on a 2-year government US government bond is reasonably attractive in the current environment, given that it is the highest rated security, internationally rated security that you could hold in your portfolio. At the local level, again, you would want to be sticking to higher credit quality in terms of bonds, whether or not you're looking at government or corporate issues. So if you can get your hands on government or government guaranteed securities, which is somewhat of a challenge in the local environment for TT dollar investments, you should be sticking to that particular type of investment, or repurchase agreements that are collateralized by very high credit quality securities, such as government bonds or government guaranteed bonds, or high credit quality issuers, such as some of our banking institutions, large investment grade rated banking institutions. At the international stock level, for the ultra low risk investor, while this would be a smaller component of your portfolio, you would certainly want to be looking for value in the current environment, and that is stocks that have a lower price to earnings ratio. So for every dollar you pay for the stock, you're getting more in terms of earnings per share that you generate, or paying less rather for every dollar earnings per share generated. And that would also be the same in terms of the local stock environment. And of course, you'd be wanting to look for stocks both internationally and locally where you have a higher dividend yield if possible. As we move to the conservative investor, again, you would want to typically favor those higher credit rated securities, certainly investment grade securities, both at the international or domestic level. In terms of international stocks or US stocks, definitely, again, seeking value, looking at lower price to earnings ratio stocks, or stocks with higher price targets relative to their current market prices, and certainly favoring dividend yields as well, particularly given that we are going into a higher interest rate environment. For the moderately risky investor, again, you would still want in the current environment, given that we are very likely heading into a downtrend of the economic cycle at the global level, as well as we have not really seen the bottom of the market cycle as yet. You'd want to stick to investment grade names in terms of our investment grade rated securities at the international and domestic bond level. And for international and local stocks, again, opting for higher dividend yield, less speculative names by nature, industry leaders in terms of stock positions. And you could even consider looking at highly diversified positions such as exchange traded index funds, or even sector exchange traded funds that focus on particular sectors of a broad-based market at the international level. That option is really not offered at the local stock market level. And finally, for the aggressive investor, under more favorable market conditions, these types of investors would very often consider distressed investing opportunities. They would consider very low credit rated securities. But in the current environment, we would certainly recommend staying away or shying away from those particular positions. If you are going to dabble as a very aggressive investor in non-investment grade securities or speculative grade securities, we would suggest that you stay very, very close to that investment grade line, which is BBB minus. So securities which may be just below investment grade, supposed fallen angels at the BB plus or BB credit rating level, but certainly you wouldn't want to be holding securities that have a much lower credit rating, for example, single B names or even CCC names in the current interest rate cycle, because those types of bonds are more likely to encounter financial distress and or default with rising interest rates across the global interest rate environment, as well as slowing economic growth. And for international stocks, again, in 2021, we would have seen a shift towards very significant speculative positions. There was a lot of interest in companies that were pre-revenue, that were pre-production of any goods or services. They would have had an idea and were raising capital and basically investors saw the sky as being the limit for some of these stocks. Many of those stocks have corrected in 2022, and good sense is seeming to prevail. There is certainly a shift back towards a value bias across investment markets, certainly in terms of in the international stock markets. And even if you're aggressive, you should still be seeking value and definitely not going into stocks that might be pre-production companies, so they might have a prototype but not started any official production of goods and services, that might just have a pretty good idea, that might be a special purpose acquisition company or shell company. Those stocks that, or those types of securities that were all in vogue in 2021 should certainly be shied away from in 2022. And we're typically not a firm to comment on cryptocurrency, but also cryptocurrency is under pressure. So currency related securities, you may also want to think twice about before averaging in or thinking that you're getting a particular bargain in the current environment. And that really takes us to the question and answer portion of our presentation today. And I'm seeing that there's a lot of questions that have been posed so far. So I'm going to open the floor to our moderators, or part two members of our team, Carissa and Shona, and maybe they could pose some of the questions that have been asked by our attendees so far, and I will try my best to answer them on the spot. And if we can't answer all of the questions, we would definitely prepare a Q&A sheet and circulate it to all of the participants.
Good afternoon, sir.
Hi.
I'm seeing a lot of good questions coming in. I'll start with this one's pretty vague. Is it better to invest locally or internationally?
Oh, okay. Well, it's not a vague question. I think it's an excellent question. And again, with our theme that we would have put forward of diversification, I think you should do a bit of both. The extent to which you can and will do both would have obviously be dictated by your ability to access foreign currency. But there are merits to investing locally. One is that our stock market has typically been a little bit less volatile than what would be experienced at the international level. The second is that investors might be a little bit more familiar with some of the stocks or the companies that they are investing in and the products that are being offered. But at the international level, of course, there are or have been concerns about the valuation of the Trinidad and Tobago dollar. And while we do not think that is a near-term risk, certainly as an investor, if you have access to foreign currency, you would want to be saving and investing a portion of your wealth in international holdings as well. So it's a good question. I think you should do a bit of both.
Somebody would like to know why the Bourse trader account is set at a 5,000 US minimum, because they wanted to invest in Apple, S&P, and a dividend ETF, and would like to know your thoughts on those. Okay,
well, every account has an account minimum. I think we have a fairly low account minimum compared to some of our peers in the industry, except maybe one. Generally, in terms of Apple, the S&P ETF, etc., those are all good. Well, Apple is certainly a bellwether stock. I would probably defer to the consensus analyst estimates in terms of a price target for Apple, as opposed to saying that I know everything about the company intimately to be able to give a good projection about it. But it is one of those companies that is an industry leader, that is blue chip, large cap, and certainly will be around for the foreseeable future. And the S&P index ETF is certainly a good diversification option as well. So if you are less able to monitor your investments over time, but just want to know that you have some stock market exposure, I think the S&P ETF is certainly a good security or well, good ETF to have in your portfolio as a long-term holding.
We have a FCB APU question.
Sure.
Seeing as the share price is raised to 53 presently, would there be more room for growth?
Well, I mean, so First Citizens is a very good, well-run, well-capitalized bank. I think there was a lot of interest in the company given its pending acquisition of Scotia's Guyana operations. Unfortunately, that has fallen through in the past couple of months. But the CEO is a very dynamic CEO, and she would have intimated Ms. Karen BC that they are going to seek to expand and diversify geographically, which is a good positive point for not just FCB or First Citizens, but many other companies that are seeking to do so. So I would say that long term, it is a good addition to the portfolio. The fact that the APU price was pretty much very close to the market price may have disappointed some investors, but on the flip side, you are able to secure a portion of shares without having to pay trading commissions and things like that. So I would say go for it if you're a long-term investor, but I wouldn't necessarily expect any short-term significant pop in the share price over that we may have been accustomed to with some IPOs and APOs in the past.
Hi, Sarod. So we have another question from Ravindra Mahadev. Do we at Bourse provide advice on investing in stocks, etc.?
Oh, well, that's an easy one. Thank you, Carissa. Yes, the answer is yes. We do, and you can feel free to set up a consultation with one of our client reps at any of our offices, Woodbrook, Chaguanas, or San Fernando, and we would be happy to walk you through what might be the best investment path for you based on your specifics.
Okay, great. Another one is from Mr. Singh. Based on the negative turn of the global trends, would you advise heavy investment here with the expectation for higher returns as the trends inevitably improve?
Oh, that's an excellent question. Also, we also may not need to give out the clients' names or the participant names, but it's an excellent question. Investing is a marathon, and there are inevitably hurdles or pitfalls that the market encounters, such as this. While it is difficult to say that, given all of the uncertainty, that there is an end in sight to the market volatility that we're experiencing in the near term, certainly the valuations that are on offer right now are much more compelling than they were at the start of the year. Could markets fall further? Yes. So if you are thinking about making that leap, I would suggest being a little bit disciplined in doing it, and maybe utilizing one fairly common approach, which is a periodic investment in a period such as this. So every month you could average in or buy a portion of stocks or securities, so that you have neither regret from buying when the market went much lower, or buying in the market or missing the opportunity for the market before the market bounce back up. Having said that, with high interest rates, the continued geopolitical risk and inflation forcing policymakers to really think hard about what their next step is, I wouldn't expect the market to bounce back very sharply anytime soon.
Okay, another question. In the view of the possibility of a US recession, is investing in a US investment fund wise to do now?
Well, again, that's thanks, Carissa. That's a very good question also, and it's fairly similar to the previous question, in that where there's a lot of uncertainty but valuations are perhaps compelling and attractive, employing a fairly disciplined approach of periodic investing might be a good strategy under the current circumstances. And again, that's because there's very little light at the end of the tunnel at this particular point in time. But the same was said in maybe April of 2020, when there was extreme uncertainty because of COVID, and certain policy decisions were taken and certain initiatives were made, and that really flipped the direction of the markets in a short space of time. So I would continue to invest, but do it in a disciplined way.
So I like this question here. How can someone obtain international stocks?
Okay, so there are many broker dealers. I would say Bourse is the best, and you could just open a international trading account with Bourse, because our offering is called the Bourse Trader, and it does have a $5,000 minimum US, and our trade desk would be happy to execute orders for you. We would provide research on international stocks and help you to make a more informed investment decision. You could also, if you want to take or invest internationally, you could also look at mutual funds that are offered by Bourse and others in the market locally, which have the benefit of professional investment management for those portfolios. So it's more of a set it and forget it type of arrangement, where it's much less hands-on for you as an investor.
Okay, this individual would like to know, are bonds better than stocks investing?
Are bonds better than stocks? Okay. I like bonds, but the long term, statistically, equities outperform. Again, it's really up to your personal preference. If you can wake up in the morning and your portfolio is down 20%, your stock portfolio is down 20%, and you're happy and you know that it should recover in the long term, and I'm hoping that it's a highly diversified portfolio that you're holding, then go for the stocks, especially if you're also at the younger part of your life cycle, your personal life cycle. You have a longer recovery horizon for market cycles such as this that we're currently encountering. But bonds, I think the major benefit of bonds is that you get that steady income, and there's that certainty or degree of certainty of returns by holding fixed income positions. So again, it's all down to your personal preference. If you like that certainty or relative certainty of return, I'll be leaning more towards fixed income, but or bonds. And if you like the romanticized make it rich in a very short space of time, and you expect the stock markets to always go up, then I'll probably lean a bit more towards the stock, investing in the stock market.
We have some you'd like to know which stocks and bonds fall into the shown categories for moderate and conservative. So how would you know?
In the presentation.
Yes.
Okay, so let me just go back and it's for moderate, sorry.
Moderate and conservative.
Okay, so let's look at the conservative. Well, the conservative and moderate, it's basically about your credit rating. So typically, you would want to be focusing on investment grade type securities. So anything that has an S&P rating of BBB minus or higher, a Moody's credit rating of Baa3 or higher, and even some local bonds that may or may not have a Caricus rating, you'd be looking at that particularly the credit rating, which is usually a good reflection of how safe a bond is. Let's phrase it that way. Shona or Teresa?
Okay, we have another interesting question here. What advice would you give to a company looking to make a first-time investment into the stock market?
A company?
Yes.
Well, I guess it would depend on what type of company you are. If you're an investment company, I guess, and also depends on your risk preference and your risk tolerance. Now, if you're a company that's just looking to make, better use of currently of funds that might be currently earning 0% or near zero in a bank account, and you don't have any particular use for that cash at this point in time, then you could consider perhaps a mix of fairly liquid short-term investments, but also a mix of equity type funds or equity type positions. But again, that's a fairly tough question to answer with limited information, because it really depends on the type of risk, the liquidity needs that is unique to this particular company. And also consider mutual funds whose income is tax exempt, or distributions rather tax exempt under the current legislation. So you might get a fairly competitive rate of return by utilizing mutual funds relative to maybe other types of investments.
Okay. What are the best stock options in the local markets for both a 5-year and 10-year time frame?
Oh wow. Okay. Well, I think over the 5 and 10-year time frame, it's very difficult to tell. I mean, if I could have done that, I'd probably be very wealthy and be retired. But we typically make 12-month forecasts, and that's really because we think we have sufficient information to look at what the fortunes of certain companies would be. So in our earlier slide, we would have mentioned we have 3 overweight rated stocks: NEL, TTNGL, and First Caribbean International, FCI. And we like them because of different reasons. NEL and TTNGL in particular, because energy markets are on a bit of a upswing right now, and we expect that to filter into earnings and into distributions to investors in terms of dividends. And for FCI, we like it because it's fairly attractively valued relative to the other banking stocks on the Trinidad and Tobago Stock Exchange, as well as an attractive dividend yield north of 5%, as well as the fact that you're buying this asset in TT dollars that pays you a US dollar dividend. 5 to 10 years, I would probably stick to the major companies, the Republic Financial Holdings, the First Citizens, for example, the very large cap stocks. I think one of the Agostini is a company that I think is very progressive, and they are making the right strides in terms of their geographic expansion. So those are some of the names that I would say would be fairly valuable as part of the portfolio over the next 5 to 10 years. Having said that, most of the companies listed on the TTSE, the Trinidad and Tobago Stock Exchange, are fairly well run and fairly stable in terms of their operations.
Okay. Based on external factors, do you think that the Central Bank of Trinidad and Tobago would increase the repo rates?
Well, that's a tough one, and I wouldn't like to be the central bank governor at this point. But the central bank is walking a tightrope. They may have to take action, or they may feel compelled to take action to arrest inflation that is continuing to trend upward in the Trinidad and Tobago economy. However, as we would have mentioned in our presentation, the source of inflation primarily for Trinidad and Tobago seems to be imported. And increasing the policy rate, which really increases the cost of borrowing, really might make it more difficult for companies to reinvest in plant and machinery. It will make it more difficult for consumers to take loans to buy their next big ticket item, their next house or e-house, or a car, or even household appliances and things like that. And with prices increasing, consumers may actually be more open to utilizing credit to make some of these major purchases of consumer durables. So increasing interest rates might have more of an impact of dampening economic growth in the non-energy sector than it would in controlling inflation, because it may not necessarily decrease the prices that consumers pay for goods and services, given that it is that those prices are increasing because there's the raw materials, the commodities, the manufacturing inputs have gone up in price.
Are there any upcoming bond issues or IPOs that we are aware about?
That I'm aware about? No, I can't say. But I mean, it is useful to keep in contact with your reps at Bourse or whoever your preferred broker dealer is, and I'm hoping it's Bourse, to keep up to date with whatever is available in the market. In terms of the bond market, it's generally inactive, for want of a better word. And with respect to APOs, we typically know when the rest of the market knows, and it's made public.
Okay, I have a question here. Can money market funds keep up with inflation locally?
I would not think so. Even money market funds internationally struggle to keep up with inflation. In fact, if you can find a money market fund in the US that pays 9.1% to match the current year-on-year inflation, please let me know. I would definitely want to look at that fund. But typically, a money market type fund is really for the more conservative-minded investor who may want to have ready access to their funds. So they want that balance of liquidity, safety, but they also want to earn a little bit more than what they would be earning in traditional bank accounts or savings accounts, which is not very hard given that those accounts typically pay near zero rates at this point. So I don't think that income funds would really be able to keep up with certainly short-term spikes in inflation. And that's not really what they're designed to do. They're designed to provide a superior rate of return with balanced with safety and liquidity to investors.
Okay, I have an interesting question. What factors would you consider when trying to diversify the types of local bonds and stocks, example, energy versus another sector, that an individual investor would purchase assuming a moderate appetite for risk?
Okay. Well, I think one of the easiest ways an investor could achieve that sort of diversification is by looking at a growth fund. Bourse manages the TT Capital Growth Fund, for example, and there are other growth and income funds that are available, mutual funds, that is. And that's a very easy way for investors to get diversification with active management, in a very easy and convenient format, which is much less hands-on in terms of management. If, however, an investor is looking at doing their own self-type management, I would look firstly at the weightings of the different sectors on the Trinidad and Tobago Stock Exchange, and that information is usually easily available at top research investment houses like Bourse, and start from there. So, for example, the banking sector typically accounts for about 50% of the total value of stocks on the Trinidad and Tobago Stock Exchange. So you might want your equity portion of your local stock portfolio to be 50% invested in banks. And from there, again, you talk to the pros like Bourse in terms of what their market view is for the different types of stocks. And within that allocation of whatever you're putting towards the banking stock sector, you could pick the stocks that are expected to outperform and avoid the ones that are expected to outperform. So that's just a general type of approach that I would use if I was going to self-manage my own portfolio of local stocks.
Okay. Do you advise investing in commodities?
Well, yes and yes and no. It depends on the type of or the type of instrument that you're going to utilize. We typically like commodity related investments that are based not on the underlying commodity directly, but perhaps a company that's in the commodities business. So for example, BP, or you might look at Petrobras bonds, or you might look at a natural gas shipper stock, a midstream company stock or midstream operation. So TTNGL, for example, sort of a midstream company that is locally available as an investment. But investing directly in commodities, as in I'm buying oil or I'm buying natural gas, is most effectively achieved utilizing futures contracts, and that really is sort of outside the realm of most average investors. You could use exchange traded funds as well that correspond to the price movements of these different types of commodities. But there is an inherent level of volatility built into those types of investments, one. And two, there are other administrative risks that you may be taking on. The ETF, for example, could do a stock split, or there could be some degree of fraud or anything like that. So we prefer to take indirect commodity risk exposure as opposed to direct commodity exposure.
Okay, another person wants to know, should a conservative investor purchase treasury bills or government bonds, and how do these differ? Can individual investors purchase this type of financial instruments?
Right. So a treasury bond is typically more than 1 year to maturity. Treasury bills are less than 1 year to maturity. Treasury bills are discounted instruments, meaning that you don't get paid interest. You just buy, let's say you're buying $1,000 worth of these bonds, you'd pay $997 or $990 today, and in 3 months or 6 months time you'd get back $1,000. So that's a discounted instrument, and that's T-bills. I do believe you can. Unfortunately, we are not one of the primary dealers for T-bills. Treasury bonds or government bonds you can access, and they are available either over the counter or across the Trinidad and Tobago Exchange. And it's very easy. You can visit the Trinidad and Tobago Stock Exchange website to see the listing of bonds that are available. Or you could, of course, give us a call at Bourse as well, and we could make some information available. So, but yes, they are available. In theory, you can buy them. It's just a fairly illiquid market, in the sense that most investors that buy these bonds tend to hold them to maturity. So it's not a very there's not a very active secondary trading market.
Okay, you didn't mention the CLICO mutual fund. Is that safe? And will it actually convert to the Republic Bank shares over the new year?
Okay, that's an excellent question. So it is supposed to, barring any special changes to any special votes, I think it's supposed to convert it's supposed to liquidate or unwind and pay investors in specie Republic Bank shares and or government bonds or cash. As it stands, we feel that investors will be receiving RFHL shares or Republic Bank shares. There has been nothing so far to indicate otherwise, and this is expected to take place in early January 2023. So it is a good investment because the underlying securities are Republic Bank shares, which is a fairly stable, well, not fairly, it is a very stable company. They have been expanding geographically, very well run, very significant market share in Trinidad and Tobago. And well, of course, government bonds are pretty much the safest TT dollar investment that you could hold as an investor with Trinidad and Tobago dollars. So yes, we do like CIF.
Okay, I know we're going over the time allotted for the Q&A.
But we have
But-
5 minutes.
Okay, because we have a lot of questions still coming in.
Yes.
Okay, do you think that the TTMF IPO will be done this year?
I think the Honorable Minister of Finance did mention in the fiscal 21-2022 budget presentation, I think, if my memory serves me right, that it would be carded for the second half of fiscal 2022, which comes to an end in September. It is, I would imagine that that's a fairly tight timeline. I'm sure, you know, persons would definitely welcome it as another investment option or part of the investment menu. But it's difficult to see that, you know, the TTMB, Trinidad and Tobago Mortgage Bank, or the merged entities IPO would take place before the end of the fiscal 2022 period.
Okay, somebody's inquiring if they will get this recording and how would they get it?
Okay, so I think we will be on YouTube, and I think we'll also have the recording on our website. So certainly you can touch base with us, and I guess through those channels, or you could also specifically request a link, and we could make that available to you.
Okay, another question. Traditional media stocks, Guardian Media and One Caribbean Media have declined sharply over the past few years. Do you anticipate any recovery of these stocks?
I think the business model has changed for the traditional media stocks fairly significantly. So until and unless they do make, you know, fairly significant changes to their own business model, it would be a challenge. I mean, you know, even for Bourse, when we think about how we go about spending our advertising budget, the lion's share of it really goes towards digital marketing campaigns and social media campaigns. And these, you know, 10 years ago, you know, the lion's share of our budgets would have been through traditional media. And I suspect that's not really unique to Bourse. I think everybody, you know, who's not living under a rock would basically go that route. So I would want to believe that the media companies outside of the one-off major events like the World Cups for Brazil, like the you know, the cricket World Cups, the Olympics, etc. I would want to imagine that outside of that, the traditional media companies are looking at ways to upgrade their business model and perhaps diversify as well. But you know, if that does not occur, I think it would be, you know, continued struggles for traditional media staying in traditional media.
Okay, what advice would you give to young investors who are looking for short-term growth?
The advice I would give to young investors looking for short-term growth is don't. Investing is a long-term prospect. Sometimes you might get really lucky. I remember when I just started out, you know, I just bought a couple of random stocks, and I you know, my most vivid recollection of investment success was buying Nell when it was like $5, and you know, when it got to like 15 or 16, I was like, okay, I made 3 times my money, I'm out. But that's not always how it works. So, you know, it's about discipline, it's about patience, and it's not about short-term gratification. Investment, the definition of investment is sacrificing short-term consumption for long-term gratification. So don't think about it as I want to get short-term returns. Think about it as I want to build my wealth over time, and I want to be patient and smart about it. So you may have the one-off home runs, or, well, to bring it back, you know, locally, you might hit them for 6 every now and then, but it's about knocking the singles and just accumulating those big inning scores over a longer period of time.
Okay, so this is concerning investments in money markets where the capital investments are preserved. Which US money market funds do you recommend?
Where the US money market funds, well, I mean, I would only be in a position to recommend one, which is the US Investment Income Fund managed by Bourse. And it pays a reasonably good rate of return of 1.75% per annum. And for corporate clients, that those distributions are, tax-free or tax exempt. But there are many others. Less and less there, it's becoming a little bit less common to see fixed NAV or capital preserved income funds, but there are other alternatives. You could look at US dollar repurchase agreements, for example, which are also offered by Bourse, among others, but I would say we are probably the better rates. And that, is a low risk investment solution, which is money market in nature, because, you could do a one-year type investment or even shorter. And, you have that security and low risk built into the product. So US dollar investment income fund managed by Bourse or, US dollar repurchase agreements.
I know we are past the 5 minutes, but I have a question here.
Okay, Shauna, could we take 3 more questions then?
Okay.
Okay.
So do you all facilitate trading on the Jamaican Stock Exchange? And then I have another person asking, what do we think about investing in the Jamaican Stock Exchange? Okay, so yes, we do. Through we have 2 counterparty brokers in Jamaica, so we could get you set up with an account in Jamaica. And we could also place trades for you through Jamaica on the Jamaican market. Well, I think the major challenge for investing in Jamaica. Wow, that's a strong earthquake. I hope everybody's okay. So that is a strong earthquake. So yes, we can facilitate investing in Jamaica. The Jamaican market is a jurisdiction that we do a little bit less coverage on, but of course we could always get information from our correspondent brokers in terms of research and make it available. Jamaica again is a very cyclical environment, and they may have peaked for the short term, but I would say that it is worthwhile considering Jamaican stocks as well. Somebody would like to know what exactly are equity funds.
Equity funds? Okay, so an equity mutual fund is basically a collection of securities. It's effectively a portfolio of stocks that investors can buy and sell readily. So instead of you buying, let's say, 50 different stocks, you could just buy an equity fund or equity exchange traded fund. And in that one security or one unit that you hold, there would be multiple different types of stocks within that single investment. So that's really what an equity fund is. All right, so let's take 3 more questions, Shona.
Okay.
Yep.
So this one, do you think it's better to get RFHL exposure through CIF, given its NAV to the market value?
Okay, that sounds like a really good question. I think
they also have a following up question to that, saying that, do you think that when it's converted, will it be at the prevailing NAV?
Okay, so I will ask one of my equity analyst team members to just remind me what the NAV is right now of CIF versus what the market price is.
I have here that the NAV last recorded here is $31.01.
And the market price?
Right now is $28.90.
Yes. So based on that differential, getting your exposure to RFHL might be better achieved by purchasing the CIF on the open market at the lower price. And yes, whatever the NAV is at the at maturity, assuming that you receive RFHL shares, you would receive that value, the net asset value. So in effect, right now, you're buying, by buying CIF or purchasing CIF, you're effectively buying RFHL at a little bit of a discount relative to buying RFHL directly on the exchange. Two more questions.
Okay, so if we have a certain amount of money to invest right now, could you point us in direction of where to invest, given that we would like moderate dividends?
Moderate dividends. Well, moderate dividends might sound like, you want to just generate some income and a little bit of growth. So again, if we think about the moderate portfolio, let's go back to there. You'd probably have a little bit less cash, just 15% in cash. You'd have about 45% of your portfolio in bonds, whether it's a mix of international or local, or depending on whatever your currency that you have to invest is. It could be all international or all local, and 40% of it could be in international stocks. If you're looking at moderate dividends, I would say that you're probably looking at dividend yielding stocks. So anything that's north of maybe 3.5%, those are stocks that you'd probably want to keep in your portfolio. But again, that's sort of a very broad-based question, and the real value of a company like Bourse being on your side is that you could come in, have a conversation, we get to know much more about what you'd really like to achieve, and then we'd be able to better recommend how you structure your portfolio. And I think we'll take the last question, and I see Carissa unmuting. So Carissa.
Does Bourse have options for investors to participate in US structured notes?
Coming soon. I would say that coming soon, yes. All right, and structured notes, for those who may not know, are alternative type investments where you could get enhanced income relative to traditional bonds, but you do take a little bit more risk. And I see Shona unmuted, so we'll take a final question from Shona.
Okay, this question, is there a list that you could provide with US and local stocks that pay dividends?
That a list? Well, it's a very, yes, for the local stock market, it's fairly simple. We just have about 30 odd stocks or so. For the international market, we would have to run an equity screen, which we can do. So I would suggest that you could contact your preferred Bourse rep, and we could help you. You could provide a bit more guidance in that regard for the stocks that do pay dividends in US as well as TT dollars. And okay, so we have 2 more minutes till 3:25. So I guess we could take one more question or 2 more questions.
Okay, so I have here, given the further US Fed rates increasing, do we also expect that the bonds yields locally would it increase? Okay, so local bond yields mean, particularly on the longer term end, and I'm talking TT dollar bonds, they may be less affected by increases in US interest rates. Certainly our domestic bonds, domestic issuers in US markets, their yields should go up as US interest rates go up, which means that their yields may get become further attractive. So I would expect that if the US Federal Reserve does increase rates by another 1 to 1.5% from here, where they currently are, that you should get higher US dollar yields for local or regional issuers like the NGCs, the TGUs, Trinidad and Tobago government, the TSTTs, etc. And the last question for real now. Okay, I have a question here about if you would trust the credit rating agencies with their ratings. given what happened in the financial crisis?
Right. That's a really, really good question. I would say that they're probably the best, the most reliable gauge of creditworthiness, notwithstanding what would have taken place in the financial crisis of 07-08. And if we take a walk back in time, perhaps the guys on the other side of the table, which were the guys structuring, subprime loans, mortgage-backed securities, etc., they might have been a lot smarter than, the guys who were in the credit rating agencies at that point. I think that, the credit rating agencies have come a long way, one, in terms of their knowledge and know-how, and two, I would, be fairly confident in placing reliance on credit rating agencies for the plain vanilla type bond issuances. They really got into trouble, or really had a hard time, rating the very complex securities, but the simple, straightforward bonds, I think they do a reasonably good job at rating. So yes, I would, place some trust in them. All right, so I think, we've had a really excellent session. I wanted first of all thank everyone who would have taken the time to share with us. I really want to thank you for your engaging questions, your very interesting questions. I also want to thank the Bourse team, from the marketing team, the investment and research team, our sales team, who would have made sure that our clients and the wider public were informed about this opportunity to have this conversation. And I really want to wish everyone a great day. You can catch the replay on YouTube and on our website. And until our next session, or at least until the next Bourse report on Monday morning, CNC 3, we'll see you next time. So keep safe and, happy investing. Take care.